Welcome. Today I'm going to discuss what is the value of your business, how do you work that out, and how do you increase that value. It is exactly what most business owners want to do, is increase the value of their business. Today I'm going to show you an awesome tool we use to understand the value of your business and areas that you can improve to increase the value of that business. We'll also discuss the cash flow of your business. Cash flow is closely linked to the value of your business. Lots of business owners don't understand that. These days, a lot of businesses are funded by loans or by equity from the business owners themselves. It doesn't necessarily generate the cash that is required to increase the value of the business. So we'll discuss that, also work out how to increase the cash that you have coming back to your business. There are two parts to increasing the value of your business. The first is to have an easily repeatable system. The second is to have marketing that automatically draws more customers into that system. The reason that this increases the value of your business so much is because it gives you a great ability to scale your business. If you have a system that you don't have to work in, the more automated the system, the better. So long as that automation ensures that the customers still get the great result that they want. And when you have a great system, then you can focus on pushing more and more customers into that system. One of the mistakes lots of business owners make is pushing more and more customers into a system where they are doing the majority of the work themselves. And of course, as they push more and more into the system, they end up with more and more work to do, more stress, and they get to the point that they don't want to expand any further because they have that feeling that if they try to expand further, they're going to have to work harder. And that's not the case if you can get a good system in place. Using the tool we're about to show you, we can help you understand how the profitability and cash flow of your business is associated with this. This will be shown in the results of your business, and the results are the profitability and the cash flow. Today we'll quickly talk about this manufacturing business just as a sample so that you can understand exactly how this works. As you can see, the revenue is increasing each year, so the business is growing its customers. The gross profit is increasing each year, so the net profit after tax is also increasing each year. The expenses of the business, so depreciation, is reasonably steady. Interest is increasing. Tax paid is reasonably steady. There's no extraordinary items. The dividends paid, so what's going back into the pocket of the owner, has increased sharply in the first year. Then it's steadied and dropped a little. The assets of the business have increased each year. The cash in the business has disappeared. The amount of people that owe us money has increased. Inventory, so the stock on hand, has increased. Our total current assets increased slightly. Now fixed assets have increased and then plateaued. If we look at our liabilities, our total liabilities have increased. Our accounts payable, so who we're paying money to, has increased. So our total current liabilities, ones we have to pay quickly, have also increased quite significantly. So when we look at our funding for our business, our current loans have also increased steadily, and our non-current bank loans increased to start with, and they've remained steady from that point forward. So this will give us a quick summary of the business for the last 12 months. This business has a good gross margin, overheads that are well less than the gross margin. So it is operating at a reasonably good profit. The revenue from the business has increased, the gross margin has increased. Interestingly, the operating profit as a percentage from prior years has actually decreased. The net profit overall has increased. If we look at the story of our balance sheet, total assets less our liabilities equals the equity we have in the business. Total assets are quite high, but so are our liabilities. The accounts receivable days, so this is the amount of days that it's taking us to receive money from our customers once we've sent invoices out to them. As you can see, that is a reasonably long period of nearly 80 days, and it's actually moving out. So last year it was 75 odd days, now it's 79. Our inventory days, so this is how long our stock is sitting on the floor for, has also increased. So this is the time it takes between when our stock is completed, ready for use, and when we receive the cash from the clients. Our accounts payable days has also increased. So this is who we owe money to and how long it takes us to pay them. An increase in that is actually a positive to us because it's a positive to our cash flow. So a combination of all these, our working capital days is 154 days. So it's a long time for us to be funding from the point that we've purchased our inventory until the point that we receive the cash for selling. So this is the story of our cash flow. What is funding the operations of our business? So as our business grows, we're getting more and more of this short-term funding required to operate our business. This is represented in our cash, which is obviously zero. Our short-term bank loans have increased. Our long-term ones haven't this year, but as you can see, there's quite a significant increase in our short-term funding. So our net cash flow is actually negative 193,000 because we've increased the loans that we have when we don't have any cash on hand. So we'll move forward now to look at the value of our business. As our business is making profits, generally we would think that this business would be quite valuable. So last year it made a $700,000 profit. However, if we use a calculation for earnings before interest, tax, depreciation and amortization, which is the EBITDA, using that calculation is the basis for this model, and it understands how important the cash flow of the business is, not just looking at how profitable the business seems to be. So in this situation, we would like our business to be worth $2 million. Based on EBITDA, it's only worth $207,440. And this is with an EBITDA multiple of 4. Basically, what that means is we work out the EBITDA value and then times it by 4 to get this number. So as you can see, even though the business made a big profit last year, the value of the business is not that valuable when you grind down to what the cash flow of the business is. So now we're just going to look at how we can help fix that. This section of our tool is known as the power of 1. So currently we're showing a net cash flow of negative 193,000, even though we have an operating profit of 701,000 reflected in both positions. If we increase this by 1, you can see the impact that this has on the business. So the impact on cash flow is to increase the cash within the business by 160,000, and it increases the profit of the business by 144,000, and these numbers are reflected at the bottom. So what is this 1? So the power of 1 is basically to increase everything by 1% or 1 day. So a price increase of 1%, a volume increase of 1%, a reduction in the cost of goods sold of 1%, a reduction in the overheads of 1%, a reduction in the number of days it takes us to receive our money by 1 day, a reduction in the amount of time our inventory is sitting on the floor by 1 day, and an increase in the amount of time it takes us to pay those that we owe money to by 1 day. As you can see in here, an increase in price by 1% has a much better impact on cash flow than an increase in volume of 1%. So instead of chasing new customers, we increase the price. Chasing new customers reduces our cash flow by 4,800. And that clearly is what this business owner has been doing, chasing new customers. There's a cost to that, and the cost of that at the moment is outweighing the cash that's actually coming into the business. However, a price increase to the current customers of 1% would actually have a significantly different effect, increasing the cash flow to the business by $51,000 in this situation. The impact on the profit is also significantly higher with an increase in price over an increase in volume, because the increase in volume, again, the marketing, the extra work that needs to be done to try and find new clients, sell more of a product, is much higher than simply increasing the price of the product. So for this business, we would look to try and work a program in to increase the price and reduce the amount of overheads they're spending on trying to find new customers. In this situation, selling the product at a higher price works significantly better. Let's increase the price in this situation by 4%. We'll say that that will actually decrease our volume by 2%. Because we're putting the prices up a little, we expect to lose some customers. The increase in price will have a significant effect on our cash flow by increasing that with a combination of these two by 215,000, and our profit will go up by around 225 or so. So concentrating on an increase in price over an increase in volume should also reduce our overheads. So let's say we reduce those overheads by 4% also. At this point, we'll leave our cost of goods sold where they were, so we'll make that nil. We'll look at reducing the accounts receivable days. So the other thing that we'll do is we'll spend some money to reduce the amount of days that it's taking us to collect our cash. And as we saw, the collection of the money was quite high, it was up around 80 days. So let's reduce that down by, let's say, 4 weeks. As you can see, a reduction by 4 weeks. To take that from around 80 days to around 50 days has a significant increase on the cash flow of the business. Let's say that this will also, in effect, decrease our inventory days by 28 days. We'll work on getting a system in place so that the business is much more efficient in completing and delivering items and then getting paid. So let's reduce that by 28 days as well. So we're going to spend some money on our overheads. To be able to achieve this, we have to put money into here. So let's say we put on a few new staff members and we spend 110,000. Let's make it a clean 10%. So we're going to spend 120,000 working on our systems to get these things into better shape. Look at the result of what that means for our cash flow. Because we're not having to fund this using short-term funding for the amount of time that we are at the moment, the result on the cash flow of our business is significant. Let's leave our accounts payable days the same as they were and have a look at what the difference is in our business. So we're looking to increase our price, which we effectively feel will have a small decrease in the volume. Even if we were to make this a 4% price increase and a 4% decrease in volume, as you can see, it's still a much better result. We're going to spend $120,000 making our business more efficient by being able to collect our cash 4 weeks quicker and by having the process for our inventory more efficient by 4 weeks. This is the overall result. Now, if we look at what that has done to the value of our business, as you can see, our target was $2 million. The value prior to those changes was valued at $207,000. Those small changes has increased the value of the business significantly. This tool is so powerful that when you can see how your business operates and how the cash flow is affected by changing different things in your business, it can significantly change the amount of cash in your pocket and also the value in your business if you look to resell at some point. Understanding how spending money on the systems to make the systems more efficient in your business is the crucial part of this. If you're happy to spend lots of money on marketing, but you're dropping customers into an inefficient system, you'll be leaking cash and the value of your business can't go up as significantly as it can if you put money into the system in your business. This example shows quite clearly how spending money and looking at the efficiency of your business can make a significant difference to its overall value and the cash that you have in your pocket. If you would like to know the value of your business based on this cash flow model and understand how you can increase that value, the areas that you can work on in your business to increase your profit, increase your cash flow, and increase the value of your business, contact us on querygps@gmail.com.